This is a example of a business forecast that can be set up to help you and your business and for financial future in whatever capacity there may be. It's a pretty simple forecast. Let me just walk you through the layout. The information that you're going to need is data, type, and date. And so I like a monthly forecast because I can see trends and I can see seasonality and stuff like that. And then if you scroll down to the left, you'll see I have revenue, SG&A expense, operating expense, interest expense, taxes if that's applicable to your business, and then it takes me down to net earnings. So there's two statements that can help you build a forecast to make sure that tie to your financial statements with your income statement and then your statement of cash flow. Cash is king in any business, and so we're going to want to reconcile that down to our cash bank account on a monthly basis. So if you keep scrolling down here to the bottom, just like your cash flow statement gets you down to your cash, we're going to do the same thing on the bottom here. So we're really going to use those two statements. So even if you've never done a forecast before, if you have your income statement and then your statement of cash flow, that can help you make a forecast just off of that information. This can be as complicated or as simple as you would like it. In this case, I've only have one revenue category and I have a few expense categories, SG&A expense, operating expense, and interest expense that are all broken out on the income statement. However, if you wanted to have more visibility to maybe specific types of revenue, maybe you have five main categories, all you would simply do would be include five new categories like this, set a budget for each, and then you would actualize each of those on an ongoing basis. This document alone by itself isn't enough to do a very detailed budget. And so I envision actually doing a separate, more detailed revenue budget and a more detailed expense budget to get you to these figures here. Usually that can be performed off of data that you have to kind of see trends, historical, goals for future growth, all of that information. The idea behind this is more of a summary file that can help really business owners see what's happening in their business and make critical business decisions. So again, it's up to the owner how much detail he would want to have included in this. Get this started, what you would want to do is start with history. Now, in this example, I have only 3 years of information here. But if you were starting a forecast, I would go backwards in time to either your opening date of your business or maybe the past 5 or 10 years, just so you have some history. You could populate that. It will be useful in the future so you can see your growth, you can see what you've done in the past. It really will pay off if you spend the little bit of time it will take to populate that information. So we can keep going past net earnings. I've included some categories here that might look familiar to you: long-term debt, revolving credit line, changes in equity, capital projects. That is a very useful section for any business who's looking to expand or build upon their business. And I'll show you how this spreadsheet works with investing in different projects. And then another, you always have some things on the cash flow statement, such as cash from accounts receivable, cash from accounts payable, that you need in your cash flow statement to reconcile directly to your bank. So this works as an other category. It is for minor things, just so you can balance to your bank account. So you will always need an other section here. It doesn't have to be broken out like this. It could be simply other. And you can see right here, we're dealing with a $35,000 business and we have to have $1,200 in rounding. Not a lot of rounding. Now, when you get down to reconciling this, if you see that you're off significantly, maybe you're missing a category and you need to add another category that maybe I haven't thought of. So please do that. Also, the other category, if something is huge, when you put in the other amount here to balance, if it's large enough, go in, research that, find out what that is, and then identify, yes, do I want that in my forecast? No, do I not want that in my forecast? There are things that are in your forecast, and then there's things that are not in your forecast. Something that I've not included in this forecast that would be missing from my earnings statement is depreciation and amortization. Now, that is in your calculation for net earnings, but it's not in your calculation for cash flow, as it's subtracted when you do cash. So if you wanted to reconcile directly to your income statement, you could actually add that in as a category here. And just know in the formula down here, to get to your change in cash, you would back that back out when you're doing your formula. And I think I've actually done that for my deferred taxes up here as well. You can see that it's highlighted. Sorry, this is Google Sheets. It highlights things in a little bit different category. There it goes. You can see that I'm actually backing that out here. I'm adding it back in. You can do that as many times as you would like if you want to make it easy for reconciliation purposes. In this case, for reconciliation purposes, I do have my actual bank balance, and I've recorded that on the monthly basis, and I've added a check figure here down below that so it can identify if I'm off any dollar amounts. Now, in the future, I, of course, don't have that, so it'll just be off the whole amount, and that's okay. But on an actualization basis, you definitely want to be able to balance back to your financial records or your bank account to be able to make sure you've incorporated everything necessary that you want to bring into here. Okay, so I'm assuming in this forecast you've already built a base budget. And in this case, this is a simple base budget for revenue. It's an even amount every single month and no seasonality whatsoever in the year. And that's put in the budget. In a business forecast, because we're not going down to lower levels of data, I do want to see how it's actualizing. So for example, I want to see my budget, but I want to see, wow, what happened here? And this might impact my forecast. So if I had a huge dip in revenue, I would kind of want to see, well, wow, that's a big loss compared to what I budgeted. What happened? And maybe is that going to impact my future business? Should I expect maybe some lower revenue in the future? And if that's the case, I could actually use this other category and say, okay, my business is not doing so good, so I'm going to actually take this down $2,000. So as you're going through the year. Now, when you get out to the forecast, you can use the formula however you would like. In this case, I'm taking the total of the previous 12 months, as you can see. I'm multiplying them by this revenue growth figure. I've included this in a forecast just to show you that the technology is here, of course, to help you with this automation, this little bit of automation, and then divided by 12. So we're getting a monthly figure based off of the actualization for the past year. And then I've just copied that forward. And what that does is every time it's just taking the next previous 12 months, the last immediate 12 months going forward. So it's taking all that actualization in. And then in the forecast, if I know I'm going to have a new customer, maybe I can say, okay, I know beginning this date, I'm going to have a new customer starting in March 2025 through the end, and then that will pick it up. You've got to be careful with formulas, because one thing that you want to be careful of, if I was to take this forward, as soon as the year starts picking it up, it is going to actually count that 5,000. And if you see, I'm counting the $5,000 for the actualization, but then I'm also adding $5,000. So I've revised my revenue forecast formula slightly. So if we go back, I've actually locked in the year that I'm referencing, which is the 2024 year. And so when I copy that forward, you can see it's still going to only pick up the 2024 year. So if I wanted to add in a new customer like this, 5,000, and put it in for the 2025 year, it's not going to change this figure here. but it will change the figure for the immediate following year. So I don't have to have this 5,000 for the end of time. I just have to have it in for that first year that it would be taking place, and then that next year would pick it up. And so then this other section is freed up for more new revenue ventures that you might be encompassing. You can play around with it if you need to add another 200 here or something to get your total revenue to be exactly what you would like it. That is fine. But you can play around with, how you want the forecast to work, formula driven. And you do want it formula driven, so while you're actualizing results for the current year, it's going to flow forward to your forecast. Now, with the actual figures, that is actual in the budget. Those are values. So you always want values for your actual and your budget year. So that way you aren't changing anything with your budget year. You're just actualizing what they are at the end of the year, the end of the month. So, okay, we can keep going. I'm going to take out kind of this increase right here just so to give us back to base. And we have the same thing for SG&A, operating expense, interest. Now in this business case, I don't have any outstanding loans, so I don't have any interest expense, but I wanted to include that here so you would know kind of how I would do it. I would actually include the interest rate that you're actually paying, and then you can have your budget and then your actualization. But having the rate here is important because if you want to look back in time of why interest was high, it's important to be able to look and see what the rate was at that period of time so you know. When you go down to long-term debt, you could definitely fill in long-term debt. And actually something that's also going to be important to you, not as important to you to calculate your total cash, but total outstanding debt. So you might want to have a beginning debt of 0, but if you change your long-term debt 10,000, well, maybe you want to know what your outstanding debt is on a long-term basis, and you can add that in. So as you're changing in your long-term debt, let's say I got to borrow another 50,000, it will show you what your outstanding debt is, and so you can calculate that all the way through. You would actually, it looks like this isn't picking it up exactly, so you can calculate your interest on your long-term debt equals this times, maybe we go back up and we use the interest rate divided by 12. And so while the interest rate is working and you have long-term debt, you can see it's calculating interest here, and then you have interest here that's rolled up. This is linked to the interest in the long-term debt and then the revolving credit line. So you can kind of see how that works. Equity, changes in equity. Maybe here's our dividend payments to our equity holders. And then we have capital projects here. I'll get to that in just a second. I've already kind of been over the other category. And then here is your beginning cash, your change in cash. And this change in cash is simply a change in, just like your cash flow statement would be, it'd be totaling the change in cash activities. Let's see if I can't change that. There you go. So you can see how it works, and then you balance. Now, once you get this set up and it's balanced, it should work on a monthly basis with really no changes unless you have some type of new activity that you have to account for. For example, look, we added some interest here. So now our bank account doesn't work. So we can go ahead and go back and remove that just so we tie for this scenario purpose. There we go. We balance. All right, so let's go back to capital projects. This is really a nice thing to have, especially on the forecast perspective. You can monitor your bank account, and it can tell you if you have available funds or maybe need to finance funds for a new project. Here's a project, and how this works is you want to show your investment. So this shows $10,000 over two, or $20,000 over 2 different months. And then as soon as that project's complete, we want to show the earnings come back in. Now, the earnings calculation is the sum of the investment times the projected earnings divided by 10 divided by 12. Now, a 10-year period. So if it's a 10-year period, it's 100%. If it's anything faster, it's greater than a 10-year percent. So this project is a 5-year return. And then that will be turned on for the end of time. So when you get to your budget for next year, you would instead, for example, if you're doing your budget for fiscal year 2025, instead of having the capital project down here, you would be including that within your budget when you override this information with your actual budget. So you would be able to remove this project from this section down here as it would then be above. So this is really just for forecasting perspective. Here's another another project. We had $80,000 in the bank, and so we spent $50,000 on some type of a project. It has a 200% return over a 10-year period, and then here is our earnings on a monthly basis. So you can really see, what that looks like. Now I have built some extra formulas. This is the most complex formula in the whole thing. It is if equals this is on, then it equals 50,000. If it doesn't, 0. So what I'm trying to say is maybe I want to be able to turn off and on project. So if I want to turn off, it takes the project out. If I don't want to have that one on, and then I could turn it back on here. So it gives you a little bit of flexibility if you're trying to choose between maybe, like, let's say you have possibly 8 projects that you could invest in, and you want to see which scenario is going to work best for you, and you can select and choose. When you get over to the year, so you have dates, right? So you have your monthly. I give it at least a space or two just so you can see the separation of the months, and then you would have totals of years. This really helps you to see information, especially for these capital projects. Here's our $50,000, but look, in 1 year, we're already making $10,000. So we're going to make our money back in 5 years' time, and that would be a really good project. Anything, I think, with a 5-year return is a valuable project you might want to invest in. In order to set up the years, it's pretty simple. All it is a sum formula to go over to that specific year's data, and it brings it over. Now, I can't copy this forward because it would just bring that 1 month over. So you are going to have to manually sum each year, at least on one row, and then you copy and you paste this down to all the other cells. So all the years work out. There is a little bit of a difference. Instead of doing a sum, you would want to do an average for the interest expense, just so your information is a little bit more accurate for you to be able to visibly see. And then when you get down to here to your bank account, the check figures are going to be a little different. Instead of using actual bank balance, because we're doing a forecast, I've actually said equals, and we're going to go back to the actual ending year calculated bank balance. So you can see I'm in December 2024. Here's my ending cash, and enter. So what I'm trying to do is make sure that my year forecast is the same as my monthly forecast. And yes, they can be this different. For example, if I miss a row, by having these check figures be the actual formulas, for example, like this one, you'll be able to see right here because it's December 2026. It will show you if you're off, and then you can problem solve, why is the year different than my monthly summaries? Let's see. That's not what I wanted. I paste values. Having some problems here. Okay. And there you go. So on the annual basis, it really can help you. You can see I've had, huge changes in cash flows, but then you can see I had investments and how much those investments were. You can go up to revenue. You can see your total revenue. Now this should tie to your pretty much your earnings statement or your income statement, and statement of cash flow for the year, so you can actually use it to help you check your financial statements, whether you're preparing them or you're having an external party preparing them. It can just help you really review everything. As part of, you saw this revenue growth figure right here, right? I am including an expense growth figure right here. So this you can play around with. Expenses are going to go up. It's just going to be an unavoidable thing, but having something like this plus inflation will help you be more realistic in your forecast. And you can change this to whatever you think it might be, like 102.6, 103. And you can come up with your own forecast. This also will help you plan. Now, I've built this to be a pretty profitable business. That might not be the case. You might be a little bit more tight, and you might need to actually use this forecast to see how much revenue growth do I need to have to match the expenditure growth. And you can play around with this to see how you would need to incorporate that. And by using freeze panes, I should just kind of mention how I do this. You go view, freeze, up to 3 rows, up to column D. You do have to kind of have your cursor in the right cell. But so view, freeze, up to 2 rows, view, freeze, up to column C, and it'll put it right place. If you're in Google Sheets, you can also move this thing around, so it will freeze those panes. And so that way, if you're scrolling over or down, it will keep the same headers. So as we go out to the years, you can definitely see how expenditures have grown with that little bit of an increase. And so you can definitely see, well, your net earnings is definitely going to go down if you keep everything the same. Now, fortunately, in this case, we are doing projects, so we're actually making more money than we were previously. But you wanted to fix your forecast to know that next time you're going to do your budget, you're going to put in a price increase maybe on your inventory. And so you can try to match up with inflation. All right. So this is a business forecast. So this is just a basic business forecast. Hopefully this will help you. If you ever need help or anything setting up a business forecast, please feel free to email me or check me out on my website. And I'd be more than happy to get something started for you so you can manage that go forward. It does take a little bit of time to set up, but I'm sure, I set this up in just a few hours. If you're doing a 10-year forecast, you might have to do a day or two of work. It's definitely well worth it once you put the time in and you can start managing it and actualizing it for actual results to see kind of how things are going to go and what the future is looking like for your business. So thank you for listening. Please leave me comments. Thanks.